Good evening everyone, this is Abid Khan and you are watching Karachians Academy YouTube channel. In our series we are doing A-level accounting past papers, right? A-level accounting paper 9706 and it's version 2. So we are doing 9706 paper 3 version 2 and we are working on May-June attempt 2022, the latest one, right? So we have done with a couple of questions. So now we will do question number 4. So we will do question number, I think we have done with the question number 2 we have done right now. We have finished this. Now we will do next one is question number 3. So let's see what the question number 3 says. The directors of K Public Limited Company provide the following information at 31st December 2021, right? Profit for the year 114,000, right? A dividend paid 90,000, ordinary share ₹1. It means number of shares are 600. The value in dollar divided by, so it's a $1 share. So retained earning 1st January, opening, this is opening of retained earning, data is closing and this is opening retained earning. General reserves 75,000 and 80,000 revaluation reserves and 8% debentures. Clear. The market price of one ordinary share, it is the face value of the share is 1, but in market, in the stock exchange, it is means selling at 2.4. The market price of the shares are 2.4. So let's move on and see what the question. It looks a very comparatively easy question. Answer the following questions in question paper. Questions are printed here before. Okay. What explain 2 ways in which accounting ratios may be used by potential investors. Potential investors means prospective investors. Okay. To assess the performance of the business. 2 ways. The 2 ways we can move. We can see the marking scheme. Its answer we can find from marking scheme. The 2 reasons. Number 1, the comparison of the performance with another company in the same trade. If a potential or the prospective customer or shareholders want to invest in our company, so through this ratio analysis he can compare your company with the other companies before making any decision. Number 1. Number 2, comparison of the performance with previous years of the same business. If they can also how the business was performing last years and in the previous years, so they can, through these ratios, they can assess the performance of the business. These are the 2 reasons. Now move on. So we calculate 2 decimal places. 2 decimal. Number 1, price earning ratio. So first is, so I'll be doing questions here. Number 1 we have to do is price earning ratio. I'll be calculating this here. Question B, number 1, price earning PE ratio. The formula for the PE ratio is market price of a share divided by earning per share. Market price by earning per share. So market price is already given and actually we have to finish it very quickly. Market price is given 2.4. Earning per share we can calculate. Number of shares we have. Earning profit for the year is also given to us, so no issue. So we can EPS. First we have to calculate EPS. EPS would be 100 and this is earning 114,000 divided by number of shares. Number of shares are 600,000. So EPS will be, let me open up my calculator. Yes, 114,000 divided by 600,000. Earning per share would be 0.19, right? 114 by 114 divided by earning per share. Okay, 0.19. What did this mean? Now, $1 of your market price earns how much earning? 90 cents. The earning per share is there. So PE ratio we can calculate. PE ratio will be market price. Market price is 2.4 divided by earning per share is 0.19. So 2.4 divided by 0.19. How much is this? 12.63, right? So this is earning per share 12.63%. Move on. Dividend yield. Number 2, we have to calculate dividend yield. The formula for the dividend yield is dividend per share divided by market price per share. So market price per share we have 2.4. Dividend per share we can calculate. No, it's not a big deal. So how much dividend we are getting? So dividend per share we can calculate. Dividend per share is how much dividend? 90,000 of the dividend per share, 600,000 shares. Dividend per share is coming dividend per share is 90,000 divided by 600,000. This is 0.15. Market price we have. So dividend yield we can calculate. So dividend yield will be dividend per share 0.15 divided by 2.4 in terms of percentage. 0.15 divided by 2.4 into 100, 6.25%. 6.25%. So dividend yield 6.25%. This we have calculated, this we have calculated, and this we have calculated. Now income gearing, what is the formula for income gearing? We will see, we will do this here. Number 3 is income gearing. Formula for income gearing is interest divided by, or you can say profit or earning, whatever say, earning before interest and tax, or you can say profit before interest and tax. Okay, interest, how much we have? We can calculate interest. Debenture interest on debenture is 8%. So 150,000 into 8%. 150,000 8% will be 12,000. So interest is 12,000. Interest on debenture is 12,000, and earning before interest, this profit of 114,000, this is a profit for the year. So this we have arrived on after deducting the interest. So we have to, if interest we want to profit, if we want to arrive on the profit before interest, so we have to add this back. So profit before interest and tax, this will be 114,000 is the profit. You already have deducted 12,000 from this, so this will be 126,000. okay, interest we have, then income gearing will be equal to, interest is 12,000 and this is 126,000, and we can calculate 12,000 divided by 126,000, right? 533. We quickly have to finish this. So this is into 100, 9.52. Income gearing is 9.52%. We're done with this. Gearing ratio. So fourth one, gearing ratio, this equal to, the formula for the gearing ratio is interest divided by, so gearing ratio is basically your debt to equity ratio. Space is less, so we can do it here. Gearing ratio, debt to equity ratio. So this will be debt, and your debt is this one, divided by debt plus equity. So we should see how much equity is. Equity will be this profit will be added to, by the way, your equity is, profit will be at the later stage. We will how much this is equity, ordinary share capital, which is 600,000, and then retained earning, we can general reserves, which is 75,000, revaluation reserves, which is 80,000. Right, 600,000 and 75,000 and 80,000, and then retained earning. Retained earning, you have balance 38 plus you are earning 114, so this will be total and minus the dividend you have paid. This is dividend, so earning 38 profit plus retained earning opening plus 114 profit, this is 152, and out of this 90 you have paid dividend, so this will be 62,000, right? So if we do its total, so total will be 600 plus 75 plus 80 and then 62, so this will be 817,000, right? So then this, so debt equity ratio will be carrying ratio. Debt is 150,000 and debt plus equity 150,000 and plus 817,000. So 150,000, 817 plus 150. This will be 967,000. Okay, then 150 divided by 967, which is 1.15 for 15%. So gearing ratio is, you can say, 0.1551, or you can say 15.51%. So we have done with this return on capital employed. The last one, capital employed is what? So this one also done. So return on capital employed, your capital employed is this one. Capital employed you already have, which is debt plus equity, and you got it 967,000, right? So 967,000, and earning before interest and tax you already have. So the formula for return on this is earning before interest and tax divided by capital employed. This is the formula. So then we have earning before interest, we already have worked out. It was this one, 126,000. So it is 126,000 divided by 967,000. Then we divide this and we can find this out. (126) divided by 967, so it is coming 13, and if we multiply by 100, 13.03%. 13.03%. So return on capital employed is 13.03. So okay guys, we have done with the part A and part B. So we have done with part A and part B of question 3. That's all for today. If you have any doubt or clarification, you can write us quickly, and we will try to get back to you very quickly. So that and hope this will be much more helpful to you for your next week exams. Thank you very much, and bye for now.